Friday, May 30th, 2025, Maneco 64, home of alternative economics and contrarian views. Good morning, Clive. How are you doing?
Good morning, Mario, and welcome to Friday again.
Yeah, Friday. And I want to start with something I saw this morning, Clive, which seems quite serious, not just for foreign investors in the US, but potentially for the US Treasury itself. And it's another example of politicians doing things without thinking of the consequences. And it looks like people have looked through this big, beautiful bill that was passed by Congress, and they found this provision. It's called Section 899 of the bill. And the FT is reporting here foreign tax provision in Trump budget bill spooks Wall Street. Legislation would erode the appeal of U.S. financial assets, banks and investors say. So let's just quickly go through this to see what it's all about. It says Wall Street is warning that a little publicized provision in Donald Trump's budget bill that allows the government to raise taxes on foreign investments in the U.S. could upend markets and hit American industry. Section 899 of the bill that the House of Representatives passed last week would allow the U.S. to impose additional taxes on companies and investors from countries that it deems to have punitive tax policies. It could raise taxes on a wide range of foreign entities, including U.S.-based companies with foreign owners, international firms with American branches, and investors. So they're saying here, because I don't want to go through the whole thing, I've read it, that it could not only hurt foreign investors in the U.S., but also companies that are operating in the U.S. and have foreign owners. And it says here the measure targets countries with what the U.S. calls unfair foreign taxes. Most EU countries, the UK, Australia, Canada, and others around the world would be affected. And it says here for foreign investors, Section 899 would increase taxes on dividends and interest on U.S. stocks and some corporate bonds by 5 percentage points every year for 4 years. It will also impose taxes on American portfolio holdings of sovereign wealth funds, which are currently exempt. And if you scroll down towards the end, Clive, it says, but even if treasuries were not directly taxed, because treasuries right now are exempt, foreigners, when they earn income, interest from U.S. treasuries, they're exempt from tax. But it says here, Section 899 will represent another concern for international holders of U.S. debt when many are wary of the country's gaping deficit and vacillating tariff policies. And just end here with this comment. Our foreign clients are calling us panicked about this, said a director at a large U.S. bond fund. It's not totally clear whether Treasury holdings will be taxed, but our foreign investors are currently assuming they will be. So, yeah, I couldn't think of a worse kind of provision that would really have the opposite effect of what Trump is trying to do, is bring foreign investment into the U.S. to build new manufacturing and also to keep Uncle Sam financed. So how do you see this, Clive?
Well, I think it's another reason why people will shy away from the United States in investing in bonds, equities, or government bonds or corporate bonds. At the moment, if you own US equities, you have a pretty hefty 30% withholding tax if you're an investor, say in Switzerland and UK and other places. Now, in some countries, they have a double taxation agreement. You get part of that 30% back, depending on your tax situation. But if they increase it by 5% a year for the next 4 years, as is proposed in that bill, then that would take it to a withholding tax on dividends of 50%. which is pretty horrendous and probably the highest in the world, I suspect. So people are going to say, well, why would I invest in America and lose half of my income if I do earn anything at all, when I could invest in places like Hong Kong or Japan and have a withholding tax of 0 or 10%? So it will drive people away. Now, if we talk about government bonds are supposed to be free of withholding tax. Now, I don't know if the 5% tax they're proposing added per year would take that withholding tax to 20% from zero. But it has been proposed as far as US Treasuries in a separate thing I saw that they would have some sort of user tax to get round the prohibition on having a withholding tax. So, sorry, not a user tax, a user fee. So the user fee would be basically a form of withholding because you have held a US Treasury and therefore your return, your interest would be 10, 20, 30% less. So that would be a way of getting around the prohibition on having withholding taxes on treasuries. If it comes, I think people are going to say, well, there is no reason to hold US bonds unless the interest rates are 30% higher to compensate me for the withholding tax I'm going to have to pay. So that would drive people away from the US market. And I think the mere suggestion that it might come, as opposed to it being law at the moment, not law yet, if people fear it will come, are they going to go out and buy a treasury at next week's auction, next month's auction, when they know that they might not get what's written on the tin? If they buy in the auction and they think they're going to get 4.5%, and then 6 months later it's 4.5% minus 5%, 10%, whatever, 20%, 30% withholding tax, I don't think they're going to want to bid in them.
Yeah, this withholding tax rule that government bonds aren't are exempt from it. Is that an international rule that you have or that there is?
I don't know. I don't think it's a rule as such, but I think it's an understanding. No, as far as I'm aware, all governments which issue government bonds don't have withholding tax on the bonds held by foreigners, including gilts and so forth. And the reason for that is they want foreigners to fund their debt.
I see.
So this would be, I don't think it's the law. I think it's just an international convention.
Yeah, I mean, it says the article that they're not sure whether it will be imposed on treasuries, this provision, but uh, anything's possible. And talking about Trump and the Trump administration, we saw yesterday, I don't know if you've probably seen, Clive, that Donald Trump met Jay Powell. Uh, he invited him to the White House for the first time. Well, I guess the last time they met was in 2019. So it's been 6 years. And the Fed came out with a statement, and I'll show the statement here. It's pretty, how can I say, neutral and objective. It says, here we go, statement on Chair Powell's meeting with the president, May 29th, 2025. At the president's invitation. So it was the president who invited. Chair Powell met with the president today at the White House to discuss economic developments, including for growth, employment, inflation. So there's nothing here about interest rates or anything. But then the spokesperson for the White House, I think, what's her name? Levitt, Catherine Levitt, she said that, yeah, in the FT report, Donald Trump tells Jay Powell the Federal Reserve is making a mistake by not cutting U.S. interest rates. So I think it's fairly significant that he's called them in. I know the Fed's saying, "Oh, we didn't talk about that," but
Well,
they're under a lot of pressure now.
I thought it was quite telling when I read that line, which said that Chairman Powell did not discuss. I can't remember what it was. Did not discuss. So Chairman Powell did not discuss.
Yeah,
So it doesn't say Mr. Trump.
yeah,
I don't think President Trump had a
that's a good
discussion. I
point.
think Mr. Trump was probably telling Powell what he expected. And
Yeah,
I'm being polite here when I use the word expected.
yeah, and I have here the schedule for the FOMC meetings this year. So the next one is June 17th and June 18th. So in about, yeah, 3 weeks. Yeah.
I'm wondering if we'll get a cut there. Shall we have a look at what the
Yeah.
mark the I'll bring it up on my screen here uh, to see what they say about the Federal Reserve interest rate cuts or not. Um, just a second. What am I looking for? Yeah, the CME Fed Watch is what I'm looking at.
Yeah.
And it says the expectation is that the rate will be 97% probability that the rate will be 4.25 to 4.50
So
at the
that's
next meeting.
unchanged.
So yeah, pretty much unchanged, and only 2% probability that they'll cut it.
Yeah. And I think next week will be important. We'll see the jobs data, non-farm payroll on Friday. And yesterday, Clive, we had the jobless claims, and that jumped from like it was expected at 229,000 for the week, and it jumped to 240. I mean, it's been there before of recent, but if it keeps going up, then there might be an excuse to cut because I think Jay Powell said as well. Right now, the job market, employment is pretty good, but if it weakens, we would think about cutting. So
So the probability of a cut in the July meeting goes up to 23.9%.
yeah,
And then the next meeting after that's September, and it goes up to well, about nearly 70%. So
yeah,
by September, we can expect a cut according to the CME Fed Watch.
yeah. The other thing, Clive, when the Fed cut rates back in, I think it was September 18th. And I'll bring the chart here of Treasury yields. Here we go. That's the 10-year yield. So the Fed cut rates here around September 18th, and the 10-year yield was around 3.68. And I think they've cut three times. They cut 50 on that day and then another 25 twice. And despite that, look where the 10-year yield is. It's a lot higher. It's at 441 right now.
And that's quite surprising, given that not the federal, the Treasury has not been permitted to borrow any new money since the 2nd of January, because they'd hit the debt ceiling. So whilst they've been borrowing money to renew old debt, which is maturing, they have not been able to borrow money to fund increased expenditure. So the level of the national debt has stayed the same since January, yet interest rates have continued to rise. So what will happen when they do raise the debt ceiling in July or August? Where are they going to get the money? They have to refill the coffers, and that will mean in a short space of time borrowing probably another $1 trillion, increasing the level of debt by $1 trillion. That could push up rates quite a bit then.
Yeah, and the thing is, if they cut rates again, you could see, I mean, the bond market could react quite negatively, especially the longer end, don't you think? Could we see further? Because I think what President Trump thinks and Besant is that if the Fed cuts rate, uh, all yields will come down even longer end. But from what we've seen here since September, it's been the other way around.
Well, certainly there's always a certain pressure. If you cut the short-term rates, there'll always be some investors who say, I'm chasing the highest yield. Oh, I can get the highest yield by extending my maturity from 3 months to 5 years. And someone who's at 5 years will say, I can extend to 10 years or 20 years. So there will be some of that, but I don't think it's going to be enough to turn the turn the yields around. I think the yields are going higher. I think that the 10-year, which is at 4.4 at the moment, will probably see that heading towards 5%. It's difficult to know where the point of maximum pain is reached, but I suppose it's around somewhere above 5%. And if we do get there, I expect the Federal Reserve to step in and start buying treasuries to stop the rates going any higher.
I think one of the reasons they want to cut the administration is because they want an even weaker dollar because the dollar has dropped like 10% since the beginning of the year, as per the dollar index. And despite that, the Bank of England has cut, the ECB has cut, I think at least a couple of times. Other central banks have cut. Uh, so if they cut, it would even accelerate the drop of the dollar. So I think it would be quite, maybe that's what they want, a weaker dollar, Clive. And talking about treasuries and the fact that foreigners might be a little spooked within this new provision, I saw this post on X. Uh, I think it was yesterday or the day before, and it's from Ask Perplexity, and he says, "Why you slap the price of credit default swaps on U.S. government debt has quietly risen to one of the highest levels since 2008. This isn't just market noise; it's a warning signal about America's fiscal health. Here's what's happening and why it matters." Maybe if you're familiar with credit default swaps, Clive, maybe you could explain to the viewers why this is quite significant. And my question to you, Clive, because this is insurance on the U.S. Treasury defaulting, right? Uh, let's say if the U.S. Treasury defaulted, would it be temporary or would it be for good? And would the banks that write these policies, would they be able to pay the people that insure themselves against that? Because if the U.S. Treasury went bust, what would happen to the banks, U.S. banks?
So uh, we don't know exactly the volume of credit default swaps which are out there on the US government or any other government for that matter, because it's an over-the-counter transaction. But we obviously can know the price because it's being quoted and being reported by some websites. So, for example, if you want to know what the probability of a particular country is going bust, you can look at. I've got a website up here which has the information. It's called www.worldgovernmentbonds.com, worldgovernmentbonds.com. And if you go there, you'll find the probability of default for each country based on the credit default swaps. So what happens in practice is an investor fearing a default by a country or a business or whatever, he can, if he chooses to do so, buy insurance against a default. And the assumption is that when something defaults, you get a 40% recovery. It might be more, might be less. But you're basically assuming that will be the recovery rate if a country defaults. So if the USA were to default, you expect to get 40% of your money back. Obviously, it can be a lot less than that, can be a lot more. So you buy the credit default swap, and the price you pay goes higher if the probability of default is higher. So, for example, in the United States, the probability of default, according to the price of credit default swaps on the 5-year government bonds, I've got it in front of me on the screen here, has risen by 7.95% to a level of 47.25 basis points. Now, that may not mean a lot to many people, but this website translates it back into a probability of default. They say that means this CDS value translates into an implied probability of default of 0.79%. In other words, slightly less than 1% probability of the United States defaulting. And there's plenty of countries which are riskier than that, but plenty of countries which are less risky than that. So, for example, that's more risky than Canada, more risky than France, more risky than Spain, more risky than South Korea. These are countries which are deemed by the market to be less risky than the United States. I mean, I'll list them: Switzerland, Sweden, Netherlands, Germany, Denmark, Australia, Austria, Finland, United Kingdom, Ireland, Japan, Belgium, Portugal, South Korea, Spain, France, Canada. Then we get to the United States, and after that, you start to get to slightly more riskier countries like China. China's the next one down from the United States, followed by Italy, Greece, and Indonesia, and India. So just to put that in perspective, China's probability of default is considered to be 0.86%, and Indonesia's probability of default is 1.31%. India's is 1.40%. So America is not very far away from these countries, which many people wouldn't choose to invest in because they think they're too risky.
Yeah, so
Um,
here, is this it? Sovereign CDS?
yes, that's it. Yes, you've got it up there.
Yeah, and let's have a look here though. So United States, China, Italy. Yeah, Russia is not very good.
100% probability of default on Russia.
Yeah, right there. Well,
Yeah.
yeah, because they don't have,
So you can see the United States right in the middle of your screen, Mario,
yeah, right
with
there,
a
yeah.
0.79%
So
probability of default.
Switzerland is the top dog. Uh,
Which is kind of funny because if you buy a Swiss bond, anything less than 5 years, you have a negative yield. In other words, you maybe buy a bond with a 1% interest rate. Let's say it's got 5 years to go, and you're paying 94. You'll get five coupons of 1%. That makes it 94 plus five gives you
mm,
99, and
yeah,
you've lost 1% over the 5 years. People are willing to lose money by buying a Swiss government bond because they perceive it as the only safe place to put money, or the
yeah.
safest place to put money.
Clive, talking about government bonds default, I sent you yesterday something about an American. Well, he was born in 1747, so he wasn't an American at the time. He was like a British American, Timothy Dexter, and it's a really interesting story. You guys should check it out on Wikipedia. There's also a really good YouTube video done about him. You can search on YouTube Timothy Dexter. I haven't got the link, but basically what he did, he wasn't. I think he left school, Clive, at 8, so he wasn't very well educated. I don't think he even knew how to. Well, he knew how to read and write, but he had to start working very early, and he got lucky because when the not the U.S. but the American the Continental government during the U.S. Revolution, they issued the Continental dollars, and eventually it was another one of these exercises in money printing, and the Continental dollars, which were supposed to be redeemed in the dollars, silver dollars, which was the major coin used in the colonies, basically it defaulted. It was worthless. But Timothy Dexter, not being, he bought a huge percentage of the issue at almost nothing because he thought it might come back. And so by 1781, these were worthless. So I assume he was buying around that time and the next few years. But in 1789, when the United States was created, the United States that exists today and the Constitution, they created the U.S. Treasury, and the first Secretary of the Treasury, Alexander Hamilton, decided to compensate the holders of continental dollars by paying them 1% in, well, in silver, I guess. And he made a fortune, Mr. Dexter, even though 1% doesn't seem like a lot, but it's a little bit like these cryptocurrencies, Clive. You see their prices, a lot of times they're 0.00001. And I think that's what happened. He made made a fortune from it.
The funny thing in the story, obviously, he was a very poor man, but he had the good fortune that his boss's wife died. Oh, not wife,
Yeah.
the boss's died. His boss died, and his boss had a wife who happened to be very, very rich. So he managed to, I won't use the word beginning with S, but he managed to marry his boss's wife, and then he could use her fortune to go on all kinds of wild speculations, one of which was to buy up all these continental dollars. Now, of course, he was not a particularly bright person, so everybody around him were only too happy to sell him this worthless paper for almost nothing. And then, as you say, in the end, the American government, the new government, gave back 1% of the value. So it's given that he'd bought this stuff for much less than 1% of the face value, perhaps he made 100 times or 1,000 times what he'd invested into it.
Yeah, I know. So, am I saying that maybe we should keep an eye on the worthless paper money now and maybe buy some?
Well,
I wouldn't. I don't know. What do you think, Clive?
Well, you know, if we have a currency reset where they replace the American currency by a gold-backed dollar or by CBDC or whatever you like, perhaps in some kind of emergency, there will be plenty of people buying up the old currency in the belief that they're going to give you something in the new currency eventually for it. I'm guessing on day one you'll get 70 cents on the dollar. I'm guessing after 3 months you'll get 20 cents on the dollar. I'm guessing after a year you'll be lucky to get 1 cent on the dollar for your old money. But there will be people who will buy it in the belief that someday the government will redeem the old currency. But realistically speaking, in modern history, that almost never happens.
Yeah. So, Clive, talking about investments and making money like Timothy Dexter, I wanted to share with the viewers a video you made recently, and I guess this isn't financial advice from me nor from Clive. It's just a study that he's done, and this is his opinion. And you should also do your homework, right? Right, Clive? So could you talk a little bit about this? You just
So,
published it
yeah,
yesterday, I think.
artificial intelligence or AI is coming to the world with a vengeance. And there are some companies which are leading the charge in terms of benefiting from this. They're utilizing artificial intelligence to cut costs. They're using it to improve their processes. They're using it for everything in their business. And I've gone and done a big search of the all the large companies in the world. I found 14 companies, and there are a lot more, by the way. These are 14 which I think are very good value. I found 14 companies which are using artificial intelligence in all aspects of their business and are saying in words of one syllable on their websites, we have cut costs, or we've improved output, or we've increased efficiency, or we've reduced time. So all of these companies are well ahead of the curve. And I think what's happened, they're very cheap companies. They've got high dividend yields, they've got low price earnings ratios, and they have growth.
Yeah.
And I think what's happening, the world hasn't woken up yet to the benefits that AI is going to bring to so many companies. So if you would like to, I made this video yesterday. I took some time to research the companies. Anyone who'd like to find out could look me up on
Yeah.
YouTube and subscribe.
Yeah, and I'm going to put a link to it in the description. I also put a link up here in the cards, so you can click on it. And
Thank you very much, Mario.
I'll probably watch it too. I mean, it's highly speculative, but that's the thing about investing sometimes. You got to be prepared, especially something like this, speculative, I would say, Clive. You got to be prepared to lose your money, but at the same time, you could make a lot, just like Timothy Dexter.
Yeah, exactly. It's not investment advice, but the companies are large, well-known blue chip companies. People will know quite a few of the names,
Yeah,
but they might be very surprised that these names are using artificial intelligence to such a great extent.
yeah. I mean, our AI is changing things very quickly. Um, and talking about government. Oh, actually, before we do that, just wanted to show Clive the dollar index compared to the price of gold, because here I'm gonna get rid of this here. Um, since 2008, the dollar index has risen from around 70 to, well, we're around 100 right now. So it's risen quite a bit, like almost 50%. And despite that, and I remember when the dollar bottomed there, gold topped at 1,000 around here in March 2008. But despite that, Clive, gold has kept going up, and the dollar index has kept going up. To me, that's an indication that gold is really, really strong. And it's not just about the dollar, but it's about the whole fiat currency system that it's not fit for purpose. But I've looked as well. If you look, like when gold did really well in the 70s, like from 1970, well, from from here, early 70s, the dollar went down. So it was very bullish for gold. And the same thing here from 2000, 2001, dollar index dropped a lot and gold went up a lot. But now the dollar has gone up and gold has kept going up. And a lot of people think that the dollar index now is under a lot of pressure and it could go down even more. So, what I'm thinking here, if the dollar index keeps going lower, this is going to put an even bigger rocket up gold, I think, because as we see here, since '08, the dollar's gone up and gold's gone up. What do you think?
So the dollar index is comprised of a basket of currencies which are measured against the US dollar. And we mustn't forget that all currencies are falling together. It's not between themselves, one might go up or down against the other. So the dollar, what we're measuring is whether the dollar has gone up or down versus that basket of currencies. But they're all falling in value together because every one of these countries, including the United States, is borrowing more and more money to spend. And the more they spend, the more the money which is in existence is devalued. So, where we look at the dollar index, we're only measuring it against something which itself is devaluing. And I guess the dollar over recent years has been one of the stronger ones, although not this year. It's starting to fall this year. But gold really is the only currency which is a real currency out there. And, that the reason that gold has so massively outperform the dollar or the dollar index is because there's no government out there who can print it or borrow it at whim and spend it.
Yep.
So yeah, it's that's really we're going to see more and more of this government borrowing going on, and that does mean that it's highly likely that the gold price in fiat dollar terms will continue its upwards trajectory.
Yeah, so all currencies are devaluing versus gold. That's what Clive meant. And if you look at the history here, dollar index started in March 1973, soon after the dismantling of the Bretton Woods system. At its start, the value of the dollar index was 100. So, and I've checked, the gold price was trading around 85 to 90. So that proves that over the long term, yeah, gold, whatever the dollar index does, it doesn't really matter. Gold will keep going up against all these currencies. And prior to the euro, of course, it was the Deutschmark, the French franc, Italian lira. There are more components, but now that has been bundled together into the to the euro. Yeah.
So I see up there that the next after the euro, the next biggest component of the DXY is the dollar index,
Yeah,
is the Japanese yen.
Japanese yen. Yeah, that's right. Yeah. And then the
One
British
of those.
pound, Canadian dollar, Swedish krona, Swiss franc. Just
It's a good
talk.
job it's not 100% Swiss franc because the dollar index would be have gone down from 100 to 50 by now.
Yeah, that's right. And I think having the euro diluted, be like with the Deutschmark together with the Italian lira, has kind of made it even, it could be even worse because the Deutschmark would have been a lot stronger on its own, I think. I wanted to talk about this, Clive, because, like you said, governments are broke. They need revenues. Interest rates are going up. They're desperate for taxes. So we've got this here in the UK. This is another one of these stories that, to me, makes me concerned. Well, not personally, but it's concerning for people who have saved through their companies for years. It says UK to make it easier for companies to access pension surpluses. Ministers want to release billions of pounds for investment. So This is about like defined benefit, like big companies that have like a pension scheme for their employees. I think that's closed now to everyone, but there's over £1 trillion. Here we go. The UK's 1.2 trillion corporate defined benefit pension system, which is largely close to new members, has improved its funding levels in recent years after a rapid rise in government borrowing costs boosted expected returns. So, Clive, what's happening now is that since 2022, when interest rates and government bond yields started going up, their pension pot is yielding a lot more. So if someone retires and instead of getting 2, 3%, they're going to get five or six. But prior to that, when government bonds were in the bull market and rates were near zero, they had a huge deficit. But now with this surplus, they want to take the money and put it into, well, there isn't even the money there. What is there is the potential future income, right? Because if you have £100,000 in your pot, instead of getting 20,000 like 4 or 5 years ago, now you're getting 50,000 because you can put that 100,000 at 5% on a 30-year gilt or whatever. But what they're saying now is that they want to take this potential income, extra income, and use it yeah, to put in to invest in other companies, and I think that's not right because those defined benefit pension schemes were created for the employees, and just like they had a huge deficit 3, 4 years ago, it could very well come back. So I think it's very dangerous, and it just shows more and more desperation.
Well, what's not clear to me, Maria, and maybe you figured it out, but I couldn't for the life of me figure it out when I read the article, is who actually is going to get this surplus. So what they're talking about is pension funds, some pension funds, have a surplus of assets over their perceived liabilities. And the government is proposing that some of those surplus assets can be put into private equity or equities in general, UK equities, of course. But for whose benefit? Is it for the benefit of the company which made the pension scheme, or is it for the benefit of the pensioners, or is it for the benefit of the
No,
government?
yeah.
Who's getting the money? That's what I don't
I
get.
think I read some of the comments, and a lot of people that comment in the FT, sometimes they work in these companies or they're parts of they have their pension as well, and they're quite keyed up about these things. And basically, it would be the company. They would take that money, maybe start doing buybacks of their stock, or start taking the money, or it's not even the money isn't even there, but they could use financial engineering basically to make new investments. And that's what the government wants. I'm not sure it would go to the government, but the government is pushing this. And I saw some comments, Clive. You probably remember Robert Maxwell, that
Yep.
he stole the whole pension scheme of the people that work for, was it the Mirror newspaper? And yeah, there were some comments in the comment section. This reminds me of Robert Maxwell. So I hope it doesn't happen, but it's another reason, Clive, even if you are, let's say, into one of these schemes, you've worked all your life, uh, or you're still working there, try to get some of your money out of this system and look after it yourself. It could be buying gold and silver or whatever you think is better. Or like Clive said, do some home improvements, buy tangible assets. Uh, yeah, I think this is
I
bad,
don't
and we're
I
seeing
don't
also.
think anyone should rely on the promise of a pension fund. If everything carries on normally, it will be there. But unexpected events could cause you not to get what's written on the tin.
Yeah.
So there could be many, many people who think they're going to get a nice fat lump sum or a nice fat pension, and when the push comes to the shove, they discover that due to some emergency or bad investment, like Robert Maxwell, um, and Robert Maxwell, what he did, he invested the pensioners' money into shares of Maxwell Communications, his own company, which went down the tubes. And before it all went fut, he went for a ride on his yacht and took his underpants off and jumped into the sea. And that
Yeah.
was the end of him.
I don't know if you mind talking about it, Clive, but you told me that you've had some problems with some state, not state, but well, state pensions, but the
Well, I won't go
company
into
pension.
specific names,
Right?
but I worked for a company many years ago, which was bought by another company. The net result of which the pension fund of the old company had to be liquidated. So the normal story is they pay across to the recipient company who gets the employees the correct amount of the pension fund, so the new pension fund has got enough to pay the incoming employees. That's the company which effectively bought me, if you like. But after all the employees had left the old pension fund and got their share transferred to the new employer, there was a surplus in the pension fund. So there was an argument between the previous employer and the or the Swiss government, effectively the pension authorities, as to whose money that was. Does it belong to the pensioners, that's me, or does it belong to the employer? Anyway, it went through the courts for a number of years, and I'm very pleased to say they determined that the surplus belonged to the pensioners, i.e., the people who were still employed at the time the old company was liquidated. But that was Switzerland, but it was a case which had to be fought out in the courts between the employer and effectively the government, who and the board of trustees. So the board of pension fund trustees were trying to protect the pensioners, and the employer was trying to protect itself by getting the money back.
Yeah, and I wouldn't be surprised, Clive, if we see legal cases potentially in the future against this plan by the UK government to allow these companies to access the surpluses because the surpluses actually belong to the to the employees because the fund, the pension fund, was created for them, not for the company. And apparently the trustees are going to be in charge of that, but the trustees are controlled by the company. I'm not sure they're there. They might have some of the interest of the pensioners at heart, but we'll have to wait and see. Clive, any final words as we wrap up here on
Well, I think
Friday?
the message is clear. Everybody should make provision for their own pension, and if they get one from their employer or the government down the line, they should be grateful that they'll be doing very, very well. And if they don't, at least they've made some provisions so they can survive.
Yeah, I agree. Thank you, Clive, for being on. Thank you, everyone, for your support of the channel. And make sure you go check Clive's channel, Clive Thompson, and also listen to his latest video.
Thanks, everybody. Bye bye now.
Bye.